Welcome to the Daily Market Recap, a detailed review of the market structure and the key support and resistance levels in the S&P 500 E-mini. Today is Wednesday, December 18th, 2013. The long-awaited announcement regarding the Federal Reserve's extraordinary, unconventional, accommodative monetary policy, otherwise known as quantitative easing, was announced today. The Federal Reserve announced that it would begin a modest tapering of its $85 billion a month bond purchasing program, but it would maintain zero interest rates well into the future. Despite the so-called fears of Fed tapering that resulted in the S&P selling down from the multi-year high at 1812 and selling down to 1754 during Sunday's Globex session, are over. Despite the so-called end-of-the-world predictions that would occur following the Fed's announcement, the S&P sold down below Friday's low at or near 1765, but above Sunday's Globex low at 1754, reversed direction and auctioned back up through the trading range. The rally that followed the initial sell response after the Fed announcement equaled 46 points after auctioning up to what had been resistance at or near 1784. The S&P paused intraday and then began short covering up through the trading range. Price initially stalled at the 1800 price area, but the short covering rally would not abate, and the market traded up to 1806 before ending the session at 1804. Yesterday, the S&P had auctioned up at or near 1780, and we had noted that there was no pullback during the past 2 days to retest support at Friday's low and or fill the gap at Friday's settlement down at 1765. Prior to the Fed announcement, the S&P sold down from its overnight high at 1780 and pulled back to retest Friday's low and fill the gap down at 1768. The initial reaction following the Fed announcement was that the S&P traded up to 1776, which was the midpoint of the earlier trading range. Following the announcement, price reversed direction and traded down through the earlier low, below Friday's low, and blew out all the weak longs who were unable to hold the 5-point drop down to 1760. Quite likely, the initial breakdown confused many market participants as there was significant selling at the low. We expected to see the S&P auction back up to 1784, which had been the previous high, and played a role in the sell-off that occurred last week. What was not expected was that the market would short cover all the way back up through the trading range without a single pullback. The distance between the prior resistance level at 1784-1786 and the stopping point high at 1806 equals a daily range. Coming into tomorrow's session, we would look for the short covering rally to exhaust itself quite possibly at today's high at 1806, but we should not rule out the potential that the short covering could continue up to 1812. In analyzing the developments that occurred following the FOMC announcement and assessing the possible price levels where the market might pull back off of today's high, we'll take a look at the point and figure chart and discuss the micro trade clusters that formed during today's rally. First, we see the breakout above the overnight high up at 1780 and the initial rally up to the 1786 price level. The market actually extended slightly above 1786 before pulling back down to 1780. Having pulled back to 1780, on the next retracement back to the high, the S&P broke out above the 1786 level and auctioned up to the next resistance area at 1794. There was a minor pullback off the 1794.96 high, and the S&P sold down to 1790 at or near the earlier high. Following the pullback to 1790, the short covering continued and the S&P auctioned above 1794-1796 on its way up to what had been an earlier close at 1804. The market extended the range modestly above 1804, trading up to 1806. When we analyze the micro trade clusters that developed during Wednesday's short covering rally to assess where the market might pull back to when the short covering ends, there are several potential candidates. The initial candidate is down at the 1796 price area. This was a previous high. There was responsive selling at the high initially, and there was statistical high volume when the market broke out above the 1796 price area. Ideally, the 1790-1788 price level, the 1790-1788 is a more ideal price level. There was substantial statistical high volume that traded there prior to the market breaking out above 1778, and the distance from the stopping point at today's high back down to 1790 equals the daily range. Should the market break out above today's high and auction up to 1812, we would point out that stops are located approximately at 1814, 2 points above the previous multi-year high. The initial maximum likelihood expectation price level is up at 1820. That concludes our recap for the S&P 500 E-mini. If you would like to follow our real-time commentary, we invite you to visit us online at www.followthebots.com. Log on and join us some morning at the open.